Hello, welcome. I'm analyzing today Galaxy Surfactants Ltd. This company is listed on both NSE and BSE. The company is engaged in the manufacturing of surfactants and other specialty ingredients for the personal care and home care industries. The products of this company finds application in a host of consumer-centric personal care and home care products, which includes skin care, oral care, hair care, cosmetics, toiletries, and detergent products. So, in this particular video, I'll be analyzing only the core ratios, and I won't be using the peer group analysis as I don't find any other companies which can come close to it in terms of market cap. So this will be a standalone analysis of the core ratios. The company's current market cap is at 6,824 crores. Earlier, 3 and 5 years back data we don't have for the market cap. Current price is 1,925 rupees and the book value is 337 rupees. So it's trading at a huge premium to its book value. Its highest point was 2040 rupees and the lowest price point it reached in last 1 year was 975. So this current price is quite near to its highest point. So the price is quite expensive. It has moved up quite a lot. So whenever it comes down, if the company is good, we can buy into it. These companies I'm analyzing due to my clients' requirements so that I can give my suggestion as to whether they can buy it or not, or they should ignore it. Right now it is quite high, so we'll need to wait for it to come down according to technical and then buy it. The current price earning is 27.4 times, not that expensive earning wise, but below 25 times can be considered. Dividend yield is less than 0.5%. Return on capital employed is good at 23.8. Even ROE and ROC both are at 23.8. So this company must be almost debt free. We'll check it out later. Face value is 10, there's no dilution, so that's good. Book value 3 years back was around 203 rupees and the current book value is 337. So from 3 years back it has moved up quite significantly and currently the price is at 1,925. The current number of shares in the market outstanding is 3.55 crore shares or 3.5 crore shares. OPM margin over the last 5 years on average was around 13%. So this is below my benchmark of 15. Returns over last 1 year has been 27%. So if you had invested around approximately 1 year back, you would have gained this much percentage. The company's debt is 235 crores compared to the market cap of 6,824 crores. The debt is quite low at 235 crores. Even 3 years back as well as in the preceding year of 2020, this is the latest debt. So 393 crores, 298 and now 235. So company is reducing its debt, paying off its debt. And if you see, even interest cost is quite low of just 19.4 CR. Company is collecting its payment from its customers within 61 days, which has slightly increased from where it was 3 years back at around 58 days. So the payment collection cycle has increased to around 61 days. Company's investments are very low at just 6.2 crore shares, 6.2 crores. Company's cash holding is 77 crores, which is again low. So company doesn't have investments nor does it have much cash on its books. It has to collect 443 crores from its customers. So against the sales, we'll check it out how much is the overall debtors to sales ratio little later on. Against that, it has to pay its suppliers around 301 crores. So this is quite nearby to each other. What it has to collect from customers and what it has to pay to its suppliers are very much nearby, and that is how it should be generally. There should be a balance between the two. Current working capital is positive 480 crores, that is, its current assets are more than its current liabilities by around 480 crores. Fixed assets are 718 crores, again not that substantial, so it is not very much capital intensive. 3 years back it is 456 crores, so it has increased its assets from 3 years back. Not that marginal, that it's only double, almost slightly less than double. Balance sheet is around 1841 crores. Against that we saw that the market cap was 6824. So it is trading at a quite a hefty premium to its balance sheet size of 1000. So it's almost like 3 times more than the balance sheet size. Debt is just 1 times its profit. So using the current year's profit, that is 2020's profit, it can pay off the debt if it wants to. So the debt portion is very low. So in all of these ratios, what we are trying to understand is the red flags or problems in the company, as well as good points that we can take up to compare it with its peer group, and then make our decision if you want to buy into the company. Market cap is around 2.6 times valuation wise against the revenue. So this is also quite reasonable. Below 2.5 should be good. Profit over the last 5 years has generated 832 crores. Now compared to that, the market cap is quite trading at quite a premium to the profits earned over the last 5 years. So in this way we can use different values to compare to the market cap and see what kind of valuation we are buying into this company. So against 832 crores, the market cap was around 6000 above crores. So that is a very high multiple of profits of 5 years to market cap. Cash earned is above the profits, which is good, but yet against the market cap it is quite low. And free cash flows is 625 crores. So it has almost 50% in free cash flow. If you don't understand any of these ratios, you can check out my earlier videos starting from number 1 to number 30th. These were long videos of 30 minutes. Earlier videos also, there are more than 80 videos you can check out in the playlist section. I've given the link in the description also, where if you click you can just go to the playlist option, you can check it out, and there I have explained in detail. In one or the other video you will understand what these ratios mean. Right now I'm going quickly over these ratios because I don't want to repeat again and again the same thing. Moving on, if you look at the price to the moving average, the blue line indicates the price and the black line indicates the moving average, which is 200 DMA or daily moving average. So when we compare it with the moving average of daily basis, then the price has moved above that, which is a bullish sign, and whenever it moves below that, it's a bearish sign. So it has moved up quite a bit and quite away from where its moving average is. Generally we should try and buy whenever it comes near to its moving average. So this price would be somewhere as of today 1924 rupees, and current price is 1924, and our buying target, if somebody wants to buy, should be 1575 rupees, at least starting basis, and then below that. At least for me, I generally like to buy when the price goes below the moving average or when it is in the technical chart based on RSI. So as far as price is concerned, the price has moved up quite significantly over its moving average. If we look at the price to earning, currently it is quoting at around 27.4 is the current price earning as of 24th November 2020, and the median price earning is quoting at around 24.7. So the current price earning is gone above its average. So whenever it comes to its average of the last 1 year or 3 years, we can consider as a starting point to enter into the company and buy according to that. In terms of performance of OPM and NPM over the sales figure, in the current quarter of 30th September 2020, company had generated 16% of OPM and 11% of NPM, which is both above my benchmark, but it has been fluctuating over the years at different OPMs and NPMs. Sometimes 10%, sometimes below 7%, 8%, and so on. In fact, in December 18, the NPM was 6.16%. So it's basically cyclical in nature, and different quarters give different kind of NPM margins. As of 30th September, the total revenue earned was 718 crores compared to its previous September was somewhere around 648 crores. So company has gained in terms of generation of revenue as well as NPM margin. Let us look at a few of the positives and negative points of the company. The company has reduced debt, which we earlier saw. The company has been giving a dividend payout of around 17.3%. Generally, anything above 20% should be considered good for a dividend policy. But the growth rate is poor in terms of revenue generation or sales of 6.77% over the last 5 years. The company is an FMCG company and into detergents and intermediates, which we earlier saw, which we went through. Here I am only looking out for Galaxy Surfactants, and I'll be not comparing it with its peer group companies. The company's price is just 5% away from its 52-week highest point, and the current price is 1,924 rupees. The result is up to date till September quarter-wise 2020 and annually March 2020. The sales has seen a positive growth of around 10% from its previous year quarter, and net profit wise it has seen a positive growth rate of 21% from September to September quarter. If you look at annual sales was in March 2020 2,595, and the current 12 months sales value is around 2,600, so gained slightly from March 2020. Profit is approximately around slightly less than 10% for both 2020 as well as the recent 12 months. It is also generating cash of around 316 crores. So that's at least the cash generation is 10% of the revenue, which is a good sign. The last 5 years price earning on average and last 3 years was around 19 times, and the current PE is around 27. So if somebody wants to buy based on price to earning, they can consider this as a benchmark and wait for the price earning to come around 19.6. Price to cash is 21 times, which is quite reasonable. So we need the company's price to cash to be at least around 25 or below that for a good valuation. Price to book is very expensive. Earlier we saw 5.7 times. It's trading at a very high hefty premium. We have to look at its past price to book valuations, where it was trading over the years, and then take that as a benchmark. Profits have been growing since last 5 and 3 years at above 15-16%, and whenever you see a high percentage growth rate of more than 20%, then you have to look at individual values and not go on this particular number of 27%. So check out individual values whenever you see any growth rate values more than 20%. So as far as profits is concerned, growing at 15% compounded over the years. Sales or revenue generation is 6.7% over last 5 years and 6.3 over last 3 years. So this is okay. If till the time that we see positive growth rate, it's good. ROEs over 3 years as well as latest has been always about 20%, which is a very good sign. And that is why also you'll notice that most of the companies which generate good ROE and ROCs, they get a hefty price to book premium. ROCs are also about 20% for all the averages as well as the recent 12 months. Return on total assets, the asset it owns and how much profits it's generating, is also 17%, which is very high. Over last 5 years it was 15%, so currently it is even gone above its last 5 years average. Its sales or revenues generation is around 1.7 times higher than its assets. So this is also good. We want the companies to generate more revenue than the asset it owns. Its sales are also 5 times higher than the inventory holding in its balance sheet. Any of these ratios you don't understand, you can, again as I mentioned, you can check out all the videos that I have made earlier in the playlist section. Last long-term data, if you look 5 years, profits, cash flows and free cash flows, they're all good. If you see 832 crores of profits over the last 5 years and cash generated of 1025 crores, which is more than the profits, which is good sign, and almost half of it is still left in the company as free cash to be distributed as dividend or pay off bank loans or whatever it may be. So 624 crores, so it's a good sign for the long term. On an average, it's earning around 166 crores every year since last 5 years. Market cap is quite high at 6,824, whereas net worth is 1,193 crores. So investors have given it a high premium valuation. This could also be due to less number of shares floating in the market. We see here promoter holding is quite high, 70%. So that is why I'm saying that when promoter holding is so high, then there is very less free float of shares in the market, and therefore the demand for the shares go up correspondingly. Companies has a very less debt compared to the equity of just 0.2. The ratio is 0.2. Contingent liability is also very less at just 18 crores against the net worth of 1193. Interest coverage is good, 17 times, that is EBIT is 17 times its interest payment or interest payout of March 2020. That's because the company's debt is also very low. Company's promoters haven't pledged any of their shares. The debtors are just 17% of the sales. Earlier I was mentioning that we have to look at these values. So this is also very good, should not exceed more than 30% of the sales of the recent year. It's taking around 61 days to collect payment from its customers, so which is also good. Less than 90 days is always good. NPM margin in 2020 was 8.9%, below my benchmark of 10, but if other ratios are good, we can ignore this, because we have to look at not only net profit margin but cash profit margin as well. Dividend yield is less than 0.5%. So this concludes my analysis of Galaxy Surfactants. If you enjoyed and liked this video, do subscribe and share it with your friends. Thank you for watching this video.